Hello, everyone, and welcome. My name is Lauren Jack, and I'll be your moderator for today's session on technology and transformation in financial crime compliance. Here at the Institute for Financial Integrity, our mission is to empower the professional community to protect the global financial system through cutting-edge education and training, including through events like today's. So we'd like to thank you all for joining us live. I see in the chat we have seems like a bunch of folks from Texas. So thank you all for joining us. To start off with a bit of housekeeping, for those that are wondering, today's webinar is being recorded. So you'll receive a link to the recording in a follow-up email if you'd like to share it with a colleague or forward it along. And we do have an excellent panel with us today. So we encourage you to take advantage and submit any questions you might have for them in the Q&A tab on your screen on the right-hand side. On today's panel, we're pleased to have Long joining us for the second time. Long is the U.S. Head of Financial Crime Detection at HSBC, where he leads and oversees financial crime detection activities across the United States, including transaction monitoring data, models, and controls. He's responsible for developing and deploying HSBC's dynamic risk assessment in the United States, which he covered on his previous webinar with us. We're also joined today by Andrea Ramoino, Product and Operations Advisor at Syntheticr, where he develops synthetic data that allows banks to safely test and improve their AML capabilities. He has over 20 years of experience in technology and over 10 years in financial services. We're also joined by Catherine Woods, an Associate Managing Director here at IFI. Based in our Washington, D.C. headquarters, she's IFI's subject matter lead on emerging technologies such as AI and digital assets. Her career includes over 20 years in senior and specialist positions in global banks and fintech startups in Australia, London, and Hong Kong. So if you'd like to learn more about our speakers today, please feel free to click the speakers tab in the top menu for their bios. We have a lot to cover today, and so we're going to just jump straight on in and start off with Long. So Long, on our last webinar where you joined us, you shared how HSBC has really strived to be a leader in the ethical and responsible development and deployment of AI in financial services. So what is the current scope and scale of the deployment for financial crime compliance? And can you tell us a little bit about what prompted this initiative internally?
Sure. Welcome, everybody. I'm happy to be here, and another very, very impressive panel and attendees. As we kind of continue from last year when we spoke about the HSBC's deployment for in AI in financial crime, if you look at the end-to-end financial crime compliance process, you're really looking at detection, you're looking at operations, you're looking at feedback mechanism. If you break them down, that's what essentially covers. So HSBC, as a global bank, it covers massive amount of jurisdiction, different line of business. So to effectively to monitor these transactions, look for the risk across all these jurisdictions, and frankly, to look at how they're interconnected to each other, you have to get into detection models. You have to look at how previously when we had rule-based systems where you kind of essentially are to determine if else then, if this guy sends money for this guy, then we do something. It's very slow, and it's a very slow to react to market conditions, just slow to react things that you find. So using machine learning AI-based approach, then we can improve our detection models much, much better, right? So that's one approach, one way that drove it. Second is when you're looking at your operations, looking at those investigations of financial crime, when you go through your investigations, your SAR filing, it's very, very manual. It's massively manual. I think that's majority of the cost for financial crime compliance is people and manual efforts. So if you can automate some of that, you can using the advancement of AI. It feels like I'm learning new AI techniques every day, and new Gen AIs, agentic AI, different approach, and layer them together, you significantly improve the operation aspects of it. And lastly, when you have investigations, you want to tell my detection guys, hey, I found these. Maybe your model's got to look for those things. So the feedback mechanism should also be enabled where possible, right? Considering all of these things, these are models. These are machine learning techniques. There are AI, large language models, private language models, agentic AI. Because one thing we don't have a lot of is data. So one thing I'm so happy about this topic today is that we're talking about synthetic data, because I can't wait for things to happen for me to find a target for me to train my models on. So if I have synthetic data, I can query that data. So I don't want to jump on what Andrea is going to be talking about, because I'm super excited about the topic. But in order for us to do AI effectively, we will need a lot of information, a lot of data. And I'm super happy that we're talking about that today.
Many thanks for that, Long. The execution you speak of, is no doubt very impressive, especially given HSBC's footprint and what you're talking about, learning something new every day. That's why discussions like today's are so important, right? We're constantly seeking improvement. So we really appreciate you being here to share your perspective from within such a large global financial institution. But to then turn it over to Andrea. So Long mentioned firsthand AI's hunger for data. So can you please explain to us all what synthetic data is, why it's important to financial institutions, particularly for countering illicit finance?
Absolutely. Thanks a lot, Lauren, and thanks, Long. Thanks for having me here. Just a quick point following up for the intro before. So I'm advisor of product operation at Syntheticr, and a company that I really deeply love from last year. When I realized what they were doing about the synthetic data, I got the same excitement as Long for the topic, because I had the chance to work from both angles of building compliance tools, running data teams, data analytics team, and then also I had the experience of running my own a regulated business across UK and Europe, and I had to deal myself with regulators, FCA, Bank of Lithuania, and BaFin. So when I got the topic, it was incredibly interesting. So synthetic data. Synthetic data are essentially machine-generated data points that mimic real-life scenarios. So, but specifically, when we get to talk about Syntheticr.ai, so the team that I'm helping at the moment, the way I like to describe them is more like a metaverse. Think about a metaverse where you have about 1 million entities that are consumers, small to medium businesses, and financial institutions. They're all connected with each other through transactions. And according to the demographics, the economy, and the payment rails of a specific jurisdiction country. For example, in the UK, we replicate the models of the UK economy. In the US, we will do the same. Think about the connection between these entities as a real life. So a user, a synthetic user in this metaverse, pay for a restaurant. So there is a transaction for a restaurant, and there is another transaction coming in for paying for his or her salary. And this generate clearly a large amount of transaction, as typically in a real life ecosystem. With about, in 24 months, we model about 2 billion transactions, all interconnecting these entities. And the beauty, and this is where it gets interesting for the AML use case, is that we injected into the system networks of money launderers and of criminals that done according to all the various typologies that are currently known. And therefore, you have a situation where you have entities that perform totally fine, a normal life, but at the same time, these actors also perform clearly money laundering tasks. And by having this injection of network clearly known to us, and having machine-generated, system of entity that don't have any GDPR problem, privacy issues. We have essentially a real ecosystem that mimics the real life without any legal problems, but with clear understanding of who is the good actor, who are the good actors, who are the bad actors, and can be used for testing, benchmarking, and we can talk about this later, AI, ML models, and therefore, helping how we can improve them over time.
Great, thank you so much for that, Andrea. So, Catherine, separate from synthetic data, which is part of the solution, we hear a lot about the problem of synthetic identities. It all sounds very Black Mirror. So can you tell us, and take a bit of time, is this a real threat, and how significant is this threat?
Absolutely. So we're using the word synthetic in two different ways. So Andrea has talked about synthetic data, which is, as Lauren says, part of the solution to financial crime and illicit activities. Now we're talking about synthetic identities. So a synthetic identity is a fictitious or partly fictitious personal identity. So it can be fully fabricated using invented names, birth dates, and identifiers, or it can be partially fabricated. So a partially fabricated identity would be one that combines authentic and falsified information, like a real social security number that's been compromised in a data breach, combined with a fake name. And these synthetic identities can also be associated with entities. So like a company with synthetic identities as its, kind of officers or shareholders. So AI, just to recap, I think AI, we recognize its significance to financial crime and to fraud. So I've got a few key data points on the slide. So there's up to 40 billion in AI generated fraud losses, and 43% of frauds against financial institutions are successful. Now, you can create a synthetic identity, or you can undertake a fraud against a bank without using AI. But what AI does is it accelerates how fast you can generate these identities, the scale of this activity, and it makes them more credible because you can use AI generated identity documents. You can use them to create the kind of layers of activity and public presence that make it seem more like a real authentic identity. So to answer your question, Lauren, yes, this is real. This is actually already happening. It's estimated that 1 to 3% of bank accounts in the United States, just using the US as an example, because we have the data, are already opened using synthetic identities. So they're used for fraud, like credit fraud, and we can come back to some examples of that later. They can also be used to launder money. So you open an account using a synthetic identity, and then it's used for funneling or pooling or other steps in the laundering process. And linking the synthetic identities with AI, FinCEN analysis indicates that criminals they're already using Gen AI to falsify documents, photographs, and videos to circumvent CDD, and financial institutions are already identifying this and reporting that this is happening. So just to recap, we have synthetic identities that are being used by illicit actors to bypass counter illicit finance and financial crime controls, particularly CDD and KYC. And then on the other side, synthetic data is used to help models be more effective. So it's not as though synthetic data is the solution to synthetic identities. Synthetic identities are one of many measures that illicit actors use. And synthetic data is one of the many measures, and a very important one, in countering financial crime. So they are both use the word synthetic, but they are using it in slightly different ways.
Great. Thank you, Catherine, for that, distinction, making that clear. So, Long, since you spoke on our previous webinar and walked us through the DRA, how has HSBC continued to adapt and evolve your use of AI solutions? And can you recap for us some of the advantages that you are starting to see?
Sure. Yeah, absolutely. In the US, last year, we deployed DRA for the our international wealth and premier banking customers. So that's around February, and shortly after we rolled out to our commercial banking customers, and so that is now covering in the U.S. both our IWPB, we call it the retail customers, and two-legged person, as my friend Chris says it, and the commercial banking now. So we're working through our direct global banking and correspondent banking customers now, and that should come shortly. So that's on the DRA side. We've also got a couple of other things that we are using AI for, a part of the detection model, namely try to find network based on trades, based on information of customers, and we can extrapolate, and that gives you a much more visibility into all the trade patterns. So those are the detection model. So the goal is to reduce our overall alert volume, because when you have a rule-based platform, if you're casting a very wide net, you're essentially saying, tell me everything that is within a very broad criteria, and let's find those, and then let's let human filter that for you. The idea here is reduce the alert volume, but at the same time, we want to make sure without missing anything. And the alerts that we do fire, they are material, and they are useful for our risk detection processes, right? So more signal, higher value on the signals, but less noise that we all have to kind of deal with false positives. We've seen a lot of alert reductions, but less to do with the volume reductions, but it's a lot to do with the less productive alert reductions. We see a lot less false positives. We've seen way better SOC conversion ratios, and more importantly, with our immediate deployment, we don't need to reach out to clients anymore as much anymore, right? So we're not having to check with them to ask questions, because we see a lot more information. So the SARs we're filing are raising on much more material. We actually, as part of our testing, we've actually seen SARs that we file have actually captured illicit transactions that we previously only was able to capture because there was a subpoena or there was a request from law enforcement. So we are seeing much better, interesting things. Yeah.
Thank you, Long. So it sounds like you're seeing progress. You're continuing to hone the results to ensure that what's coming through is less noise, more material, better quality with the signals. But how are you continuing to ensure that model accuracy, the explainability as the use of the model evolves, extends? Like, how are you going about that?
So, building AI isn't just buying a kit and you throw it in and forget about it, right? So this is a model. So models require monitoring. We have very robust model monitoring in place to keep eye on the performance and stability over time. So we all hear about, we all do and perform below the line testing. So we run a very structured below the line testing process to catch anything that we potentially miss or potentially doesn't meet the threshold, but could be risk relevant, right? So we look at those to make sure we don't miss anything, and if we need to adjust the threshold, we do that with a proper governance authority over the things that potentially need to adjust the thresholds. Also, the model has to be retrained. Think about models as a new employee, right? You bring somebody on, you train them, but you got to constantly retrain them. So this is the same thing we do with the models. So after a period of time, we run end-to-end retrain workflows to figure out what is needed through time periods or any perhaps threshold adjustments, and also we look at what are the new risks that we've now finding. So that goes back to my feedback mechanism that we talked about before. Now things have changed. Now we have a brand new typology. What happens? How do we train our models to find them? So this is where a human in the loop helps. Human, machine, analytics, and then feedback mechanism that gives us a full view of what we need to do to retrain and re-up our model skills, right? So we have a risk discovery process, we have an emerging risk process. So it's not just maintaining it, but also keeps upscaling and how these risk patterns evolve, how these typology evolve, and we have to evolve with it.
Okay, great. So last question for you on this. So when you're talking about, ongoing maintenance, and what would you say are the different considerations for financial institutions between implementation and then ongoing management? If you're aiming to compare different AI solutions out there, how would you identify which is most suitable, for example, when it comes to accuracy?
So I always say, we're always looking for new tax and new ways of putting things in. HSBC is, we look at a lot of technology, we look at a lot of solutions, but the whole idea is we got to look at things as a end-to-end process, a whole life cycle, right? So from detection to operations to our investigations. So the focus is like really working backwards. I always, the guys I work with, they all say how me saying work backwards, right? What is the objective you want to reach? Let's work backwards. So we always, when we look at new techs, we're always looking at making sure the tech is not driving the process and the outcome, but it's the process and the outcome driving the tech. Machine learning, AI, LLM, these things are so fast. They're developing so fast, so quickly. I feel like sometimes I be in a panic because I feel like I don't know anything anymore. If I go on vacation for a month and for a week, I come back and I feel like I don't know anything anymore. So we're always looking at new things and always learning new things and try to build. Try to build or look at what some of the best market leaders are doing. The more I look at these, the more we find is, technologies are great. Agentic AI, LLMs, different machine learning mechanisms, different visualization, different way. But at the end of the day, they need to achieve your objective. Everything is great on paper, right? So you want to test them. You want to fail fast. You want to try them out. You want to, if it doesn't work, move on, right? Again, I see a lot of failures from we get too attached to the technology rather than the end goal that you want to meet, which is have that future vision. What is that you want? And then let's get tech to support it. And for us, that's a very important part of looking at new techs, new implementations, and new and ongoing management of new things. Sometimes you just gotta rip it out. Sometimes you just gotta put something new. Sometimes it's a improvement that you can get away with.
All right, thank you so much, Long, for that. I know we had a few questions for you also more specifically, which we'll get to at the end Q&A session. So thank you for kind of setting us up there. So Andrea, heading back on over to you. Adversary methodologies are rapidly evolving, similar to what Catherine had discussed with synthetic identities. So we know we have a lot of folks today on from financial institutions. Can you give a little bit of context as to how financial institutions can be ensuring their systems are effectively calibrated to identify these new methods? How do you ensure the synthetic data isn't mistaken for real data, for example?
That makes total sense. Thanks very much, Lauren. So first of all, I mean, the problem that we are clearly trying to address are already been mentioned very clearly by Long very, very well. So there is the problem of when you have an AI-based AML system, you have to get the data without the problem of privacy, the problem of legality and cross-border and so forth, right? But then there is clearly the other problem is like you don't really know exactly how good is your system until you really have a benchmark or really an assessment compared to something that is actually known. And every organization clearly goes through this problem of balancing act, right? So there is you may have a sense about what are your false positives and true positives, but you don't know how many illicit transactions you let through. You just no way of finding out. So, and therefore you have, as an organization, when you think about the economics also, right, of the ML system, you have this concept. So you have the problem of the false positives, where you have maybe your system is too strict. And typically, two things happen when your system is way too, let's say, very, very strict and trying to catch too much stuff. You got the options. You got the problem with the consumer, so a bad consumer experience because probably some of the transactions get checked even further, and there is some feedback there. But also you got the economics of reviewing alerts and reviewing cases that you're not supposed to review. So if you have a bank that say you make 100,000 alerts a year at an average, say an hour, it takes much longer or much less depending on the case, etc. If you have, I don't know, $75 per hour fully loaded, that makes $7.5 million. How many are the false positives? If you got like 20%, 30% false positives, already you're wasting more than $1.5 million, nearly $2 million. So you go very quickly. You understand the economics of why it's bad to have a system which is incredibly too strict, because you are over-analyzing stuff that is not supposed to be analyzed. But then you got the other side. If you're too, let's say, liberal, you let the system, having too many transactions coming in, then you have the problem also Long mentioned before, that you have illicit transaction coming through. You don't notice immediately, but then eventually they're gonna bite you back, because they're gonna get caught by crime agencies and so forth, and your regulator is gonna come at you for fines, potential restriction. There is a problem. There's also the economic problem of your brand. So there is all this balancing act and all this economic problem that can help you to build an ROI to really see, okay, I really need to get a grip on how good is my system is. Therefore, the typical first use case that we do when at Syntheticr is we call it the benchmarking use case, right? So we gave you a full set of our platform, so our metaverse of entities and transactions, as I mentioned before, and you run it through your system, and then you send us back the alerts that you receive, and then we can provide back a full detailed report about how is the accuracy and the quality of those alerts across different parameters, so across different type of entities, whether a consumer, whether a banks or a financial institution, or whether businesses, across different type of typologies. You may have been very good in catching certain type of typology, but not very good in catching certain others, and so forth. There are different metrics, and these help to get a really baseline on how the system is really performing against something that is known. And then from here, you have essentially a cascade of different other use cases. The assumption is any good organization, after you have to do, and that happened to us when we talk to our clients, after they do a benchmarking, clearly they want to make changes, but then you have to check whether the changes are moving the needle or not. So there is this periodic benchmark that can be repeated to improve and make sure that the organization is always on top of the evolution of these new typologies and so forth. So it's always well tuned. You can completely train your system according to again synthetic data completely, a full system optimization. And some of the things that really we're seeing recently is especially the case of the vendor assessment case. So some organizations build their own AML system in-house, some other clearly buy from vendors, and then at a certain point you have 2-3 different vendors you really have to select. And they are going to tell you that they are amazing in terms of performance, but you need to have a baseline that is independent to all those vendors. They help you to detect which one has a better AI implementation for AML and which one doesn't, and therefore help you in the decision-making process so that it's eventually better for your organization. And there are a couple of other things. You can use the synthetic data to train your team. For example, instead of using in training when you have new analysts and so forth, instead of having real data, you can use synthetic data to train them and so forth. There is all these kind of use cases that you can use to make sure you have a good sense of where you are and how you can improve and use the data to make better decisions going forward. And on the point of the, how to make sure that the synthetic data are not, confused for real one. Clearly, you're going to launch them and use them into your own UAT or test environment, and therefore clearly is a different total instance from production data. That's an easy thing that the analyst teams are gonna be able to mention. And also when we use financial institution, we create names that are not real, right? So these are all these things so that you have a very UAT test environment that can tune the system, but contain the data and not mix up with the real ones.
Thank you, Andrea. Just one follow-up question on there. You've been talking about these different use cases. We've all seen how fraud and AML are becoming even more closely interlinked. So what does this mean for data analytics being used within banks and other financial institutions when it comes to use cases?
So that's interesting, because fraud and AML has always been I always consider two sides of the same problem, which is the criminal use of funds, clearly coming from very, very different angles. The AML has this highly regulation and very highly regulated by and checked and controlled clearly by regulators for any financial institution. And is based on topologies, especially, and networks. While on the fraud side, tend to be interpreted typically as a different problem, in the sense that fraud is more like a financial loss that impacts your P&L, something you have to prevent, and you typically act on them live, on a real-time basis. So there has to be historically quite a different type of way of handling, very, very separate, but these are all converging now. For the team, for example, that is the audience that is based in the UK or in Europe, you may be familiar with a new type of, for example, legislation that came to the UK, which is called APP fraud, which is authorized push payments. So this is when a user make a payment to a business believing that it's legit, in reality has been tricked. And this is a fraud, but it's not a takeover of an account. It's actually the user that makes that payment. And that is, for example, a case where fraud is incredibly similar to ML, because you can mimic it and replicate it according to typologies of network that act in the same way. And therefore, you can catch those fraud transactions and identify them through the same system and the same synthetic data that we can offer, and they were talking about.
Okay, thank you, Andrea. So speaking of fraud, Catherine, that use case, what are the implications for financial institutions of AI enhanced synthetic identities? Can you talk us through what processes are vulnerable? How can financial institutions really be identifying the use of synthetic identities?
Yeah, absolutely. So the kind of intersections and convergences that Andrea mentioned are definitely also evident when we're thinking about AI enhanced synthetic identities. So the most obvious and the main way that they can be used during onboarding to circumvent CDD. So this is to circumvent the identification and verification processes. The way that those accounts are used can be for fraud or can be for money laundering. So we spoke briefly about money laundering already. You potentially, rather than use money mules, you can use synthetic identities to receive funds, move funds, pull, funnel, do all of those usual kinds of things that you do with laundering. They can also be used for fraud, the same way as synthetic identities have been done for many, many years. So this is non-AI enhanced synthetic identities. So one example of that is in credit fraud. So the methodology is called a bust out fraud. And what that involves is an account is opened. The account owner applies for credit card, overdraft, loans, things like that. They pay them back. Credit limit increases, they pay that back. Credit limit increases, they pay that back. And then once they get enough available credit, they max out everything. So all their different credit products, and then they default. And so basically they've used it to kind of build up to a higher amount that they can defraud the financial institution of. The significance of synthetic identities here is that if a financial institution isn't alert to what a synthetic identity is and how these methodologies work, they may just think, well, this is a real customer. They became, had financial difficulties. They defaulted on their loans and mark it as, a credit loss, an operational loss, as Andrea has mentioned. But actually, that synthetic identity could be part of a wider scheme. And it can be the characteristics of that can be used to identify other synthetic identities that are being used. So on this point, it's just worth mentioning that we are very focused on synthetic identities in the context of financial crime processes in this webinar and how they are used for that purpose. But just briefly to mention, there are other scenarios where they can be used. So a synthetic identity can be used in deepfake fraud. So this is like CEO type frauds. There are case studies, like actual real life examples of where your CEO or CFO does a video call to someone telling them, oh, urgent, it's an urgent deal. You need to transfer money into this bank account that, is actually controlled by a fraudster. And obviously that video conference, the identity is a deep fake of the CEO or the CFO. We've seen even some examples of where there's a video conference with a whole group of people, like, this is a team event. And all of the identities on that are deep fakes. So there is an article on that available in the download section. And another scenario that is gaining increasing attention is IT workers. So during the hiring process, there are very well developed methodologies used by North Korea to use AI identities to pass hiring and selection processes. Those individuals then get jobs working in IT, which the implications there are not just financial losses for the institution, but it's exposing sensitive systems, giving access to sensitive data. So we won't go into these on this webinar, but they're just a couple of other scenarios. And I think, do you want me to talk about some of the red flags that we can see here as well, Lauren?
Yeah, that'd be great. Thank you.
So I'll talk through a few of the red flags here. There is an article for download that goes into them in a lot more detail. So feel free to check that one out. So a few of the red flags are photos, videos, or documents show signs of AI generation or alteration. And I'm sure we've all seen these. There's plenty of them online outside the context of KYC and CDD. So, there's blurring around the face or the edges, changes of the skin tone or around the edges of the face or double features, or there's like an incongruence between the lighting of the face and the individual and the background and how you would expect that to present. In the context of KYC, CDD, there can be inconsistencies in the documents between that are submitted by the customer and other aspects of their profile. So the apparent age in the documents is different from what their date of birth would indicate. during live verification checks. So a lot of financial institutions and other businesses will use like a video selfie as part of their onboarding process. It makes the process much more efficient and customer-centric than the old-fashioned way of taking the documents into a bank branch. So during a video selfie, part of what's being checked is that this is a live person, not a video. So if there are indications during that the customer's using a webcam plugin or tries to change communication methods, saying, oh, they're having technology issues, they can't do the video selfie, those may be indications that they are trying to use an AI-generated identity. Other indications are if there are multiple identities associated with the same social security number or equivalent in other countries, or address or phone number. What this can indicate is these partially synthetic identities using partially authentic information. So one real social security number is then used to as a part of the multiple different synthetic identities. If multiple accounts are being opened from the same IP address or device, usually, it's roughly like, I have my mobile phone, that's my device. I have, my account open from that. If there are multiple different accounts, and by that we mean different accounts in different identities open from one device, it can indicate synthetic identities. And finally, there are some quite sophisticated behavioral and technical monitoring methods as well. So this is using things like patterns in the way that a person types or interacts with the banking platform, and they can also be used to identify potential synthetic identities. So they're just a few examples there, Lauren, of the quite a wide potential range of red flags.
Okay, well, thank you so much for that, Catherine. We're going to move on to the best practices section of our discussion today. So, Long, to start off with you, having achieved success, at HSBC with AI implementation, what advice do you have for other institutions who are considering similar implementations, particularly the smaller or mid-sized institutions? Any advice as far as how to sell the use of AI internally? Any key messages for senior management?
Yeah, that's a loaded question, but I'll do my best to answer. Understand what you want to do. Like I'm a technologist by heart, by training and by heart, but a lot of times you have to pull away from the technology part of it. You have to understand the objective. You have to understand your process. And sometimes for smaller bank or smaller processes, you might not need AI. You might just need automation, right? So, but also what we don't want to do and fall into the trap of is automate stupid, right? So there's things that you shouldn't be doing to begin with, that maybe you don't do them first rather than try to automate them. Right. So just the idea is don't buy into the hype of the technology or the tool. Just understand what you want and then really be rational about it. I talked about it before, is run fast and fail fast. I think there's a misconception that we always need a perfect data. There isn't perfect data. If my data guy tells me I have perfect data, I tell him he's lying. There's no way there's perfect data, right? So, just with what you have for the purpose that you want to, what you want to do, and that is for me is the biggest learning I pulled away from doing deployment of DRA. Is sometimes you don't need that big of a monstrous thing. For smaller mid-sized institutions, sometimes it's just, you got to consider buy versus build. Sometimes buying might be a better solution, gets you in the technology, gets you into that solution and that technology very quickly while you develop your own. And then the senior management can figure out whether they want to continue to purchase or continue to buy. Selling AI internally, I feel like I'm selling all the time, and I have a very well-honed message to my boss, which is my job is to keep you out of prison. So allow me to do my job for you. But more importantly is, it's, as Andrea said, it's an economics a lot of times, right? We talked about operations. So fraud it's a cost. It's a that's right in your bottom line. AML, you have two things. You have operation costs and you have fines that you have to consider. So looking at figure out what you want to do, right? Is it operations that you want to do to remove the effort, or is it the detection side you want to focus on, or both? But focus on what the cost is, and then figure out your solution with the technology, either bought or purchased and purchased with from another vendor, or build with a maintenance kind of consideration. How does that impact your bottom line? How does that impact your operation costs? How does that impact your potential fines and things like that? So that is basically layer everything out, and that's what I would have. If I have to do this again, this is what I would do.
Okay, great. Thank you, Long. I see some questions have come in for you in the chat, so we'll move along and then try and get to the Q&A shortly. So Andrea, a question for you. As far as best practices, how do you establish a balance between combining data to provide a more complete data set versus privacy requirements, regulatory expectations? Can you talk to us a little bit about best practices with synthetic data?
Absolutely. Thanks for this. So this is a very important, clearly, the concept of data completeness and legal burden is very fundamental. But the good things of the synthetic data is that addresses both problems without any issues. So the data are complete because are an ecosystem that is mimicking economics and demographics and rails of an existing jurisdiction, and does not have any legal burden because the data, those people, individuals, businesses, they don't exist, and therefore there is no, like in Europe, there is no GDPR issue or privacy issues, etc. And therefore you can use those data freely, and you don't have all these problems you have to check and clearly check with your legal team, check with the data and the T's and C's. You have to do something to anonymize them. All that stuff goes away. That also simplified what we talk about the cross-border data freedom. For example, if there is some organization typically have hubs that are in a country, and those are like technology team that actually act for many other branches that they go in different other countries. So they've got different laws, and typically the problem is that how do you export the data from this country to move into the system that is actually reside into another country to train this model and so forth and get the data back. And there is none of it, because clearly by not having privacy problems, you don't have any issue in moving synthetic data across countries. And you can tweak the data, just to clarify, also according to the specific jurisdiction to match the economics and the environment in the specific place. And I think the regulator is interesting because I think Long said something, he said very, very well before, because you have to, what the regulator expects is that your system, and this is across the board, any regulators that I'm aware of, they really care about your results and how you can really prove that you have improved your system. And you have to show it's not about the process, but it's about really the results and the outcome and the proof that your system is actually working. And some regulators have been much more, let's say, open-minded and open to new technologies. In the UK, for example, the FCA have created the digital sandbox, and we are partnered with them. So there is a sample of our data that is actually in the digital sandbox of the Financial Conduct Authority. And a system, an organization in the UK can actually access through that, or clearly can also come directly to us. But it's great to see a regulator that start to embrace this concept. And I'm sure there are others. I know in Europe and probably, I guess, in the US as well, they are pushing for new technologies and new ways of doing this.
Okay, great. Thank you, Andrea. So, Catherine, best practices for financial institutions in countering the threat that you've been covering for us, please.
Absolutely. So what can we do about it? So key actions for financial institutions in response to synthetic identities. The first one is to establish joint action and cooperation across the institution. So as we've covered in some of the examples, this is going to include financial crime compliance, working with teams that they might not usually work with, like credit risk, working closely with fraud and with cyber teams as well. The second one is to assess internal controls specifically for these AI-related risks. So that means looking at policies, processes, and systems. In the CDD process, that's obviously one that's particularly vulnerable. If you're using a vendor solution, make sure that you're asking the right questions as part of that vendor selection. So, for example, if you're using digital identification and verification, you should ask your vendor what measures do they have in place to detect synthetic identities. The credit loss process also needs to include consideration of synthetic identities and how they might be used. Obviously, AI can be used extensively in detection of financial crime, and Long and Andrea have covered that in very good detail. Make sure the fraud risk management process includes ongoing monitoring and assessment to identify if synthetic identities are being used. So that includes that behavioral profiling and anomaly detection, like typing speed, mouse movement, session patterns, and things like that. Make sure when a fraud loss or a credit loss is being investigated to look for whether there are other accounts that show similar patterns, and there needs to be ongoing monitoring of accounts. So the first time an account is opened using a synthetic identity, maybe that's the only account associated with that social security number. But if it's then reused in other synthetic identities, if you keep monitoring for those red flags, then you'll spot other synthetic identities being introduced into your customer base. Of course, you need to train your staff specifically on AI risks, and that needs to be customized for their role. So, investigations teams need to understand how to investigate AI-enabled synthetic identity frauds. Customer-facing staff, need to understand how an AI-enhanced video or voice might appear during onboarding. You should consider customer awareness programs, and I'll come on to those in a little bit more detail in a minute. And of course, report and share intelligence. So, for example, include reporting to credit bureaus when a synthetic or fraudulent identity has been identified to make sure that it can't be reused against other financial institutions. So thinking about protecting customers from fraud, there are increasing expectations from regulators in some jurisdictions that a financial institution has this responsibility. A bank has large data sets on fraud and how that's presenting across the customer base, whereas an individual customer only sees their own account and doesn't have the same level of expert knowledge or resources, particularly if they're an older person or they're vulnerable or something like that. So if we look at regulatory findings across different jurisdictions, some of the things that regulators will look for are implementing effective identity verification measures. So this ensures that illicit actors can't open accounts, which then can be used to present as legitimate and target others in that customer base. And a bank or other financial institution should implement effective monitoring for fraud typologies and money laundering typologies. So this is the usual things like, pooling and funneling. It should take action on red flags to prevent further fraud. So if a customer complains that there has been fraud on their account, or if there's access from unrecognized devices, the financial institution should effectively investigate that. And they should also provide refunds to customers where they are entitled to it under regulation. So, investigate, take action, and remedy the loss to that customer. Finally, they should, this was a specific regulatory finding, they should provide a live person customer service telephone line. There was a payment processor whose anti-fraud number provided only a recorded message, and customers who were looking for ways to try and reach that payment processor were targeted by fraudsters who were posing as customer support representatives. So just a few examples of what financial institutions can do to protect their customers, both for the benefit of their business and also to meet regulatory expectations.
Great, thank you, Catherine, and thank you all for sharing, best practices when it comes to AI solutions, but also how to respond to AI-enabled threats. So moving on to the Q&A, I'd like to start off with a question we received from Matthew. Thank you, Matthew. This one's for you, Long. So when using an AI model for transaction monitoring, how do you get to the point where you can trust, explain, and troubleshoot your model? How does the below-the-line testing work with an AI model, and how do you find the line the model is using? That's a lot.
That's my secret sauce, Matt. You want me to tell you everything? No. So let's just break it down a little bit at a time, right? So the thresholds, it's like anything. You establish a threshold based on the things that you find above the line and below the line, right? So that's the line. The threshold is the line. Above the line are things that you think they are risky, they yield good results, and below the line are the ones that you determine they are, they're not. They're false positive, the majority of false positive. Sometimes you have one or two that slip through, then you can determine whether they're material or not. And if they are material, then you do something about them. I hope that's a pretty standard approach that we adopt. We set a certain threshold based on the risk, and if it's below the line, then we capture something below the line. Then we trigger a reaction. Either we retrain everything, or we drop the line, or we adjust some of the criteria and the features. In terms of to explain the model, frankly, models like people, right? You are training models like you're training people. It's like my wife trains me. She doesn't really trust me all the time, and I constantly under retrain. But models, how you explain models is essentially, and it really depends on who you explain it to, right? When you explain to regulators, when you explain to folks as AI models, you typically tell them, hey, what's the use of the model? What type of risk this is? What do we use it for? What do we get the data from? And how do we trust the data? And what type of model is it? Is it a regularized logistic regression? Is it a neural network? Is it going to be a gradient booster tree? A large language model for summarization? We can talk about what's the logic behind it? What's the driver? What's the human explainable logic behind it? We're looking for these things, and we're looking for in these patterns, and we're looking for in these historical alerts or transactions or whatever you want to build. The suggestion I always have is document everything. It's if you really look at how a AI model work, isn't that different from a human, call it HI model, because if you really take down a decision, you can break into binary terms, 1 to zeros, 1 to zeros. You're getting up in the morning, I'm going to put those clothes on, because for me it's easy. It's blue and white. I only pick 2 colors because I don't have to choose. So is it a work day? Is it an off day? If it's an off day, I wear t-shirt. If it's a work day, shirt, sweater. Blue, white, that's it. So that's simple, right? So if you break that down, explain it, and that's usually how you kind of derive that. Hope that explains.
Thank you, Long. Matthew, hopefully that helped. Andrea, next question for you. So we're seeing, as Catherine showed us, AI increasingly used by bad actors to create more convincing synthetic identities and fraud patterns. At the same time, institutions using synthetic data to train and test detection systems. So the question for you is, how do you see this synthetic versus synthetic arms race evolving? And what capabilities should financial institutions prioritize to stay ahead?
Thanks, Lauren. I don't quite, see the problem of the synthetic versus synthetic data. The way I see it is more like there is a new technology. The technology is available for everyone, the same as it was the internet, like 20 years ago. Everybody has access to it. And therefore, everybody, good and bad actor, are trying to take advantage of it in different ways. So rather than having, synthetic versus synthetic data, I'm thinking about there is a capability here. And is about innovation. And Long mentioned before that clearly there are so many things that are happening within within AI that it's so interesting. I always recommend to stay ahead, looking at the time. The best thing to do is to be curious and keep innovating and see what's the new thing you can use for your system in order to be able to have better results in an AML tool.
Okay, great. Thank you so much, Andrea. Well, we're pretty much up on time. So just want to, thank everyone for joining us again live. You'll receive a follow-up email with some additional resources for reading, as well as a link to the webinar. We also covered some of the questions in the Q&A in our previous webinar, so we'll be linking that as well. And then we are meeting again next week for a webinar on enforcement actions, gleaning insights that, for compliance teams, that lessons learned. So thank you all for joining. Thank you so much, Long, Andrea, and Catherine, for sharing your insights with us. And we hope to see you all again next week. Thank you for your time.
Thank you.
Thank you.